Welcome to Market Update, your AI-hosted show. All right, two stories moving markets this week, and we are getting straight into it. Priya's here. She will find the opportunity in a burning building. And Grant is here to ask, who owns the building?
And whether anyone has insurance.
Story 1. AI names are rotating hard. The market is rewarding the infrastructure plays and punishing anything that can't show a revenue path. Story 2. The Fed went quiet this week. No signals, no guidance. And the bond market is deciding what that silence means. Underneath both of those is the same question. Is the market trading on what earnings are actually delivering? Or is it still trading on the story it wants to believe?
The rotation itself is the answer. Money moving from hype names into picks and shovels isn't narrative chasing. That's the market getting more precise about where the cash flow actually lands.
Getting precise is different from getting it right. A lot of those infrastructure names are priced for a build-out timeline that nobody has actually confirmed yet.
So the debate this week is whether earnings season is providing cover for the optimists or pulling the rug. Priya and Grant, we will find out which of you has to eat crow by the end of the hour. All right, let's run the numbers. The AI trade dominated again this week. Morgan Stanley has K-Beauty US sales on track to hit roughly $4 billion this year, which is a different kind of growth story. But the headline mover was AI names pulling focus away from what was otherwise a strong start to second quarter earnings. Indices moved broadly higher. Early prints came in ahead of expectations, and yet the rotation within the market told a more complicated story than the top-line numbers suggest. On macro, the Fed stayed quiet, no fresh signals this week, and investment firms are apparently turning to AI tools just to parse what the silence means. Geopolitically, 2 U.S. service members were killed in Jordan. One is missing, and Iran is back to threatening escalation after calling off an interim peace deal. Central Command says the naval blockade against Iran remains in place. That's your week. Priya, Grant, the numbers look decent on the surface, but something is doing the heavy lifting here that isn't showing up cleanly in the index moves.
The something is AI, and that's not a mystery. The market is concentrating into names where the revenue path is becoming visible, and early earnings are giving people permission to stay in those positions.
The rotation masked a lot of weakness elsewhere, though. If you strip out the AI names, the earnings picture is strong but not exceptional, and the index level flatters what's actually a pretty narrow leadership.
Narrow leadership is still leadership. The market is making a judgment about where growth is, and right now it's making that judgment consistently, week after week.
Consistent doesn't mean correctly priced. What I want to know is what happens to the index when that narrow group has a bad week, because the breadth underneath it isn't there to absorb it.
So the split is this. Priya sees a market that is getting more selective and more rational. Grant sees a market that is one bad print away from a disorderly unwind, and earnings season is only going to sharpen that argument. We will pick it up from there. Let's get into the mechanics of it, because the question I keep coming back to is whether the AI trade is actually distorting what earnings season is supposed to tell us, or whether it's just the loudest signal in a room full of signals. Priya, you first.
The distortion argument assumes there's a clean version of earnings season underneath the AI noise. But if the companies driving AI adoption are also the ones beating estimates, then the trade and the fundamentals are pointing the same direction, and calling that a distortion is doing a lot of work.
The problem is that investors are pricing the adoption curve, not the current quarter. A company can beat on revenue today and still be wildly overvalued if the market is extrapolating 5 years of build-out that hasn't been contracted yet.
Grant, if you waited for confirmed contracts on every growth thesis, you'd have missed every major infrastructure cycle of the last 30 years.
Missing a cycle is one outcome. The other is holding the bag at the top of one, and right now, I'd like to know which side of that we're on before I get comfortable.
So Grant, what would actually change your read? Is there a print, a forward guidance number, a CapEx commitment, something that comes out of this earnings season that moves you?
Specific revenue attribution. Not AI contributed to growth in a press release, but a line item that shows AI-related demand is recurring, not a one-time pull forward, and that the margin profile holds up as competition scales.
That bar keeps moving, though. And the market isn't waiting for Grant's preferred disclosure format to decide whether the opportunity is real.
And that's the tension that's going to run through the back half of earnings season. Priya sees a market that's ahead of the disclosure. Grant wants the disclosure before he trusts the market. We'll see which one the next round of prints rewards. Let's shift to something that's been quietly building in the background. The Fed has pulled back significantly on public commentary, and Wall Street has been filling that silence with AI tools designed to read the signals the Fed used to just say out loud. Priya, who actually benefits from that?
The institutions that can afford to build or license those tools, and right now that list is not very long, which means the information gap between the major dealers and everyone else just got structurally wider.
That's the part that bothers me. If the Fed goes quiet to reduce noise and AI fills the gap with probabilistic inference, you haven't reduced the noise, you've just moved who's generating it.
The Fed going quiet isn't a conspiracy, Grant, it's data discipline. They got burned by forward guidance commitments and they pulled back. And if private tools can parse the remaining signals more accurately than a press conference could anyway, that's a better outcome.
Better for whom, though? Because a retail participant reading the same public statement the Fed just released is not running the same model as a firm with a dedicated Fed inference system. And that asymmetry is doing real work in the basis trade right now.
Information asymmetry between institutions and retail is not new. And the fact that AI makes it more visible doesn't mean it's gotten worse. It might just mean we can finally measure it.
So Grant's concern is structural access. Priya's argument is that the asymmetry predates the tools. The question the market's going to answer is whether the Fed's silence actually holds, or whether they start talking again the moment volatility forces their hand. We'll keep watching that one. Before we let you go, Netflix has been the other story running under the surface this week. Price hikes and a pretty aggressive pivot toward live sports. Priya, where does that land for you?
The hikes are a subscriber confidence test, and so far, the churn data has not punished them the way critics expected, which tells you the content library still has pricing power that most streaming peers would trade anything for.
The sports pivot is the part I keep coming back to. Rights deals are expensive, they're long, and if regulators start looking at exclusive live sports bundling the way they've looked at other platform exclusivity, that cost structure gets a lot harder to defend.
Regulatory exposure is real, but they're not the only ones in that conversation. And subscriber growth in the markets where they've added live content has moved in a direction that makes the rights cost look more like investment than overhead.
Right. But the content model itself, outside sports, has been showing signs of fatigue for a couple of cycles now, and layering expensive live rights on top of a library that needs refreshing is a simultaneous bet on two things going right at once.
That's the bear case. And it's not wrong. I just think the market has already decided the sports leg is worth carrying the risk.
Subscriber growth bet on one side, regulatory and content fatigue on the other. We'll see which one the next earnings print forces into focus. That's a good place to stop. Thanks to Priya and Grant for keeping it honest, as always. Catch you next time. That's a wrap. Thank you for listening. Like and subscribe, and enjoy the rest of your day.